todos ellos, muchísimas gracias, y a ustedes los invitamos para que no se pierdan la oportunidad de visitar el área de negocios y conocer la propuesta de valor de los patrocinadores del evento. Y también los invitamos para que compartan con nosotros sus experiencias en las redes sociales de Riskmatics Financial con el hashtag RMTC 2022. Vamos a proceder entonces al primer keynote del día de hoy.
El cambio climático será una de las principales fuentes de riesgo en las próximas décadas. Los profesionales de la industria necesitan enriquecer sus perspectivas y habilidades para identificar, medir y modelar este nuevo desafío y convertirlo así en fuente de oportunidades. Es un honor presentar la conferencia magistral Climate Change: Implications for Risk Managers. Michael Sale es Senior Vice President en GARP, donde dirige globalmente el equipo de Institutional Outreach and Business Development. Tiene más de 20 años de experiencia en administración de riesgos, crédito, productos estructurados e inversión. Comenzó su carrera en Citigroup, donde fue vicepresidente del Global Derivatives Group. Agradecemos a la Global Association of Risk Professionals por hacer posible esta presentación. We welcome Michael to the Risk Management and Trading Conference 2022.
Thank you very much. Good morning, all. And on behalf of GARP, I'd like to thank Riskmatics for letting us have the opportunity to present to you on climate change today. I'd like to give a quick overview of GARP if you're not familiar with us. Next, please. So GARP is an independent, nonpartisan professional membership association. We have members around the world, as I think it was mentioned in the introduction. Our primary focus in our mission to support the risk management community is through our education channel, the FRM, Financial Risk Manager Certification Program, which many of you may be aware of, and now more recently our Sustainability and Climate Risk Certificate. We're overseen by senior practitioners at the board level of our organization. And as I said, we have a member network of industry professionals from over 195 countries and territories. Next. So as background for today's discussion, it's important to differentiate two perspectives on climate change and climate-driven risk. The first perspective, illustrated on the left, is how we impact the climate through greenhouse gas emissions and daily human activity and commercial endeavors. The second perspective is how the changing climate impacts us. The photo on the right is a submerged electric charging station that was built on a floodplain. A good example of how both physical and transition risk can affect us all. While straightforward conceptually, these two perspectives are interrelated with potentially greater complexity over time periods, as the more we impact the climate, the more it will change and impact us in potentially negative ways. Next. Next. Previous, sorry. So the 2021 assessment report by the Intergovernmental Panel on Climate Change provides further evidence of the physical changes occurring across our natural environment. The data points summarized in this graphic illustrate the cumulative impact human activity has had on the environment since pre-industrial times. New records continue to be set in terms of atmospheric carbon dioxide concentration, sea level rise, and other physical changes occurring in the wake of climate change. The primary takeaway from the report is that climate scientists are more and more certain about the impacts of climate change and that the urgency of action has never been greater. The focus of our discussion from here will be on the implications of climate change, including policy actions and the drivers of financial risk associated with it. We'll also take a look at some current trends GARP is seeing and how global financial firms are thinking about climate risk management. Next. To set the stage, I'll begin today's presentation by sharing a few insights on climate policy from an historical perspective, leading up to the 2015 Paris Agreement, and ending with a few key outcomes from COP26 in Glasgow last year. I'll provide an overview of how climate change can manifest in financial risk in the second phase of the presentation, including an overview of carbon pricing policies and stranded assets, the first a potential risk driver and the second a direct outcome. I'll segue from there to sharing a few insights on how firms are thinking about climate change risk from GARP's third annual global survey of climate risk management of financial firms. I will also briefly mention the sustainability and climate risk resources available from GARP before answering any questions you have at the end. I personally encourage and enjoy an interactive discussion and hope that you might ask questions along the way if you prefer not to wait. Although it may not be available in this setup, we'll see. Next. Next. So going through a bit of brief history on climate policy, climate change was first recognized as a global issue in 1979 at the World Climate Conference. Understanding why implementation of globally acceptable climate policies has been difficult requires perspective on the issues faced by policymakers over the years. One primary challenge has been the lack of political appetite by leaders to make the large short-term investments necessary to achieve medium to long-term benefits that are not guaranteed. Another major obstacle has been perceived inequities of allocating emission reduction obligations between industrialized and developing economies, creating a general lack of trust in global policy initiatives. And finally, the regional variability of climate change and its impact have made it difficult to secure buy-in from countries that may be less affected. To illustrate some of the issues, let's briefly focus on two climate accords, the 1997 Kyoto Protocol and the 2009 Copenhagen Summit leading up to the 2015 Paris Agreement. The perceived failure of the Kyoto Protocol was due in large part to the fact it was a legally binding treaty requiring high-income developed countries to achieve a static reduction in emissions relative to 1990 levels. Industrialized countries like the US were unwilling to commit to a legally binding target of this nature. Moreover, addressing the rising emission levels of emerging economies was difficult due to the hard line between developed and developing country mitigation obligations. The 2009 Copenhagen Accord was largely ineffective. Climate change was not a priority at the time in the aftermath of the 2008 financial crisis. It did, however, lay the groundwork for the 2015 Paris Agreement by supporting a limit on global temperature rise at 2 degrees Celsius above pre-industrialized levels. It also conceptualized the idea of voluntary pledges, which helped eliminate the firewall between developed and developing economies. Next. Implementation of the Paris Accord at COP21 was a positive tipping point in climate policy. In contrast to previous accords, the Paris Agreement is an international treaty with common goals, voluntary commitments, and ongoing reporting obligations that have helped create transparency and reducing the conflict between developed and developing economies. Its success hinges on the power of peer pressure. Instead of relying on legally binding obligations, the Paris Agreement supports voluntary pledges by all countries to reduce emissions. Countries are free to submit nationally determined contributions, or NDCs, essentially detailed country plans to reduce their emissions. The Paris Agreement has also supported climate mitigation and sustainable development by signaling to markets that long-term political objectives of the international community are aligned, by creating government incentives to support low-carbon business decisions, and by encouraging and supporting voluntary action by private sector actors, investors, regulators, and NGOs. Next. Building on the Paris Agreement, the Glasgow Climate Pact at COP26 last year reaffirmed long-term climate goals, encouraging countries to adapt and update carbon adaptation and mitigation plans to meet their NDCs. Other noteworthy outcomes designed to further advance climate objectives include the Global Goal to Clean Energy Statement, whereby 46 countries signed a commitment to accelerate efforts towards the phase down of unabated coal power and phase out of inefficient fossil fuel subsidies. Formation of the Adaptation Research Alliance with more than 100 organizations agreeing to support research on adaptation pathways to reduce climate change. And the commitment made to advance carbon markets by establishing standards, incentives, and rules to help support the cost-effective reduction of CO2 and other greenhouse gas emissions. Next. And I'll provide a little framework for thinking about climate financial risk or climate-driven financial risk. So climate-driven environmental changes can manifest in physical risk, while actions taken by society to mitigate or adapt to a changing climate can create transition risk. This slide illustrates the relationship between several greenhouse gas emission pathways, their impact on temperature change, and the balance between physical and transition risk. The main takeaway is that addressing carbon change is a two-sided coin. On one side, if we don't take action to reduce emissions, the threat of physical risk from a changing climate will continue to rise. On the other side, the more action taken to reduce emissions will increase exposure to transition risk. Next. It's also important to keep in mind that climate change is an additional risk factor that needs to be considered in an organization's overall risk management program. As illustrated here, climate-driven physical and transition risk are transverse risk that can potentially create credit, market, operational, and liquidity risk exposures, respectively. Next. So let's talk a little bit about physical risk, which is generally categorized as acute or chronic with direct and indirect impacts. Acute physical risk is aligned with rapid, severe, and largely unexpected climate events. Direct risk events include severe storms, floods, etc., that result in relatively higher or above average property damage claims. Indirect risk events include physical facility closures that may result in supply chain disruptions. And as we've seen over the last several years, the impact those types of disruptions can have on the economy. Chronic physical risk is characterized by slow and permanent changes to the climate, like higher average temperatures or lower average precipitation levels. Direct impacts include lower crop yields due to drought or intense heat. And examples of indirect impacts are the costs associated with adapting to a changing climate, like constructing flood walls or buildings that are more climate resilient. Next. As mentioned, transition risk results from the adoption of policies and technologies or shifts in market and consumer behavior to support a low-carbon economy. For example, the implementation of a carbon pricing mechanism to reduce greenhouse gas emissions would likely result in the revaluation of carbon-intensive businesses. And we're seeing now how renewable energy sources like wind and solar and electric vehicles can impact various sectors as well as consumer preferences as we transition toward a lower carbon economy. Next. For countries to meet their long-term carbon mitigation and adaptation objectives under the Paris Agreement, they need specific policies in place to actively reduce emissions. Emission reduction policies can focus on a particular sector or be applicable across an entire economy. I've listed a few examples here, and we'll spend a little time now focusing on carbon taxes and emission trading schemes, which are both cross-sectoral. Next. Under a carbon tax regime, the local government sets a tax or price for defined emission-producing activities. Emission reduction over time depends on the response to the tax by the affected emitters. Emission trading schemes, in contrast, fall into two broad categories: cap and trade or baseline and credit systems. Under a cap and trade regime, the local government sets a limit on the level of greenhouse gas emissions produced by specific activities. It also provides aggregate allowances for each activity, which are approximately equal to the prescribed emission limit. Carbon emitters cannot exceed the limit earmarked for their specific activity, and their allocation of government allowances are tradable. Under a baseline and credit regime, the local government sets a limit on greenhouse gas emissions for each market participant and allocates tradable credits to participants with low total emissions that fall below the prescribed limit. Market participants that exceed their limit can purchase carbon credits to cover their excess emissions. The economic efficiency of carbon policy is dependent on incremental adjustments in the tax or carbon cap. Under a tax regime, for example, the price of carbon needs to be adjusted upward for inflation, increases in real income, technological changes, and other factors like changes in fossil fuel prices to ensure emission reductions are sustained over time. Conversely, in an emissions trading scheme, the aggregate cap must decline over time to ensure sustained emission reduction. Next. The implementation of a carbon tax or emission trading scheme can have unintended consequences. Carbon leakage, for one, results in inefficient economic outcomes. For example, the implementation of a relatively high carbon tax or stringent ETS in one country may result in higher local unemployment without the intended net emission reduction benefit if the tax or cap forces high-emitting companies or industries to move their operations to a nearby jurisdiction in response. Jurisdictions with a carbon tax or ETS regime may include provisions to protect energy-intensive trade-exposed firms against adverse economic impacts from competitors operating in jurisdictions with less costly greenhouse gas regulations. These provisions could include a lower carbon tax rate, tax rebates, or free allowances for firms operating in energy-intensive trade-exposed sectors. Next. The stranded asset problem relates to transition risk, and it's not a new concept, but climate change has increased awareness of the risk in unanticipated or premature write-downs, devaluations, or conversion of carbon-intensive assets to liabilities, which create stranded assets and that can potentially trigger systemic financial risk. The stranding of fossil fuel reserves has, until recently, been the most likely scenario. While current macro factors and global energy security threats have changed the near-term fossil fuel outlook, the ongoing effort to shrink the global carbon budget and the development and implementation of low-carbon technologies continues to expose the energy sector to transition risk. Next. So summing things up, the primary risk for many financial institutions who typically have lower carbon footprints is from the impact of physical and transition risk on counterparty credit. Assessing the carbon footprint of counterparties' scope 1, 2, and 3 emissions, for example, is critical to understanding the potential impact of transition risk on the value and operating performances of their business. The implications of climate change on corporate borrowers will be different depending on their carbon intensity, operating model, and market pricing power. We see here a few examples of physical and transition-driven exposures and the direct, indirect, and macroeconomic implications on the creditworthiness or valuation of corporate balance sheets, as well as potential impacts on the broader economy. Next. So now we'll segue, as I mentioned, to share a few global perspectives on climate risk management from GARP's third annual survey. The survey was conducted last year and covered 78 major financial firms around the world, looking at how effective they were in addressing several different aspects of climate risk management. You can think of these as the building blocks for climate risk management program. As set out in this slide, they cover governance, strategy, risk management processes, metrics, targets, and limits, scenario analysis, and disclosure. GARP's 2022 Global Survey of Climate Risk Management at Financial Firms will be released September 13th. So keep a lookout for it if you find the next few slides valuable and like to see the most recent data for comparison. Next. So as you can see from this chart, the majority of firms in our survey last year have C-level accountability for climate risk. For banks and insurance companies, we found that in the majority of cases, the chief risk officer is the most common position responsible for managing and reporting climate risk. Next. And boards are discussing a range of related issues as illustrated in this chart. Climate change itself is the most common topic discussed at the board level, followed by portfolio alignment with a net zero or specific temperature goal, and the assessment of transition risk exposures. Now, if the board isn't discussing climate change and its implications, it will presumably be much more difficult for the CRO to secure the resources necessary to establish an effective climate risk management program. In other words, board management is necessary but not sufficient in terms of getting started on climate risk management. Next. When assessing which aspects of their business need reviewing, respondents indicated that it was critical to understand which type of climate risk is expected to have the largest impact on the business. Most firms noted transition risk was a priority, followed by portfolio alignment, and then physical risk. If we add up all the pieces of the pie here, 87% of firms noted transition risk, 71% portfolio alignment, and 47% physical risk. Next. We also see that climate risk does not seem to be accounted for in market pricing. As you can see here, roughly 6% of respondents thought climate risk are being fully incorporated in market pricing. Firms that felt climate risk was being at least partially reflected in prices pointed to a few areas specifically, including emerging market sovereign bonds, green bond prices, and some lines of insurance. So there's a lot of room for improvement, as you can see here, in terms of creating transparency around climate risk in the pricing of market instruments. Next. And finally, the size of risk staffs dedicated to climate change continues to grow in most firms. And I can tell anecdotally from our outreach efforts at GARP, we've engaged with many global banks on the issues, and we see them all developing their risk infrastructure to support the climate change reporting and risk assessments that need to be done going forward. Next. So GARP has a number of resources available to support climate knowledge, sustainability knowledge, which I'd like to just share a bit with you if you have interest. Next. The major thing, as I mentioned previously, that we've done recently was launching our new Sustainability and Climate Risk Certificate in 2020. In the past 2 years, we've seen more than 2,500 folks complete the program and earn their SCR holder credential, let's call it. It's not really a credential, it's a certificate, but they're SCR holders. And the distribution we've seen has been fairly even around the world, from Europe to Asia and the Americas. And we continue to see growing interest in sustainability, green finance, and climate risk issues. The curriculum covers the 7 major knowledge domains that I've summarized here. We also develop a lot of sustainability and climate risk content in the form of webinars, podcasts. As I mentioned, our 4th annual survey will be coming out September 13th. We create climate symposiums where folks can engage with us on panel discussions to learn more about the impact of climate and sustainability issues on the economy. Next. I've added some resources here if you're interested. You can go directly to our Climate Risk Hub. We also have a broad range of risk management content that I've provided a link for. To learn more about the SCR, the FRM program, you can go to these direct links. And to learn more about membership, you can visit the link here. Next. So I guess that was a fairly quick presentation. Wanted to give you a nice overview of climate, from policy action to the implications of climate change in the formation of risk management or risk issues that banks are dealing with. Would love to entertain any questions you have in the next bit of time we have available.
Presented this morning, and I would like to go further, first of all, on all these huge sort of of capabilities and new competences that GARP can give us to the organizations that get near from you. So whether you can start to giving us a broadest explanation of all this GARP offer. Audio.
Can you hear me now?
Yes, whether you can help us to meet in a broader way all what GARP can help us in the organizations.
Yeah, so as I said, my team, the institutional outreach team at GARP and GARP in general, our Global Risk Institute as well, are working with banks and regulators around the world and understanding the trends around climate financial risk. The survey that I mentioned, the results which I previewed, is done by our GARP Risk Institute out of London. But I mean, this is a topic that is evolving very quickly. And GARP, as I said, launched in 2020 the Sustainability and Climate Risk Certificate to support knowledge and awareness around the issues and to build a framework for thinking about these transverse risks that can impact, as I said, credit, market, liquidity, and operational risk. And if you go back to the slide that I had up about the SCR, we cover currently seven knowledge domains, from climate science to policy. I went over some of the highlights in policy during my discussion. Climate risk management, including physical and transition risk. The green finance market, which is expanding quite rapidly. The scenario analysis, and also sustainability issues. We have a separate chapter of knowledge just around sustainability. I mean, sustainability is a broad topic, covers a lot of different things. Climate is part of it, but as we know, there's also social and governance issues that are involved in ESG. When you think about ESG, sustainable development goals. I mean, there's a lot there that we cover within the program to give people, again, a framework, bringing it all together, aggregating the information, providing a framework for how one would think about assessing climate risk driven by climate change, risk driven by climate change, and its impact on financial institutions primarily. But I mean, corporates. I mentioned in my presentation that counterparty risk due to climate is sort of the biggest issue associated with banks and thinking about lending and portfolio alignment. So, counterparties need to be aware, corporate counterparties need to be aware of what their carbon footprint looks like, what risk they're exposed to that may be driven by climate, and how the banks that are lending to them or providing capital to them may be assessing them as counterparties. I mean, it's very critical to understand that from a corporate perspective as well. And then, as I mentioned, there's a whole host of resources that GARP develops for folks that want to stay engaged with this type of content. We're doing a ton of webinars, podcasts, and climate symposiums annually. So visit our site, check it out. There's a lot of resources to learn more about.
Great. Well, something you are talking about, and surely is a great challenge for you as an organization that has to work with lots of other companies, organizations, firms, and any kind of a structure. How do you get the C-level management of any company to understand about investment to mitigate climate change and implications, how to measure it? These changes of risk rate and possible losses, but never will be profitable, this kind of investment. How do you drive the understanding of this kind of investment in organizations?
Yeah, well, again, it starts with capacity building. I mean, the tone has to be set at the top in terms of wanting to be engaged and thinking about climate change. And as we've seen in our survey, I mean, most global firms, the boards are certainly at minimum aware of climate change, and they are thinking about the implications of it in their in their businesses, and they're working with the CRO or other people within the risk team to aggregate information about how their lending portfolios may be aligned to net zero, for example. There are a lot of banks have net zero goals, corporates have net zero goals, and so there is a lot of work being done outside of GARP on this issue, and GARP is also working directly with the regulatory community, primarily in Europe, the Bank of England, for example, on some of the initiatives that they've been involved in. Climate stress testing for one of the banks there. We're seeing the regulatory community in Hong Kong, the Hong Kong Monetary Authority, the Federal Reserve to some extent now. Most central banks around the world are part of the network of organizations involved in thinking about climate risk and addressing some of the issues that need to be thought about in terms of regulation and how we account for physical transition risk in risk capital allocations, for example. How would that look, or what's the appropriate scenario model to look at in terms of a transitional scenario or a physical risk scenario. So we engage with organizations directly. We engage with regulators. So there's various channels that we're able to work with on the issues and help build capacity around it.
One of the one of the topics of the issues we will find immediately over the top of the table while we are talking with banks and the future of risks. It comes over the warranties, mostly warranties of assets. For example, the mortgage, how it will change in the next years due to the implications of climate and the change of risks. Mortgage and the warranties for any other kind of productive loans, for example.
So I'm not quite sure I understand the question, but when banks lend, for example, on mortgages.
I mean, for example, when we talk in Europe of mortgages of 30 years, in 30 years now, due to climate implications, assets value can change a lot. Mm-hmm. So how it will change the mortgage market, mostly also whether the asset has any kind of harm and damage.
Yeah.
The value of it will change.
That's a great question, and I think it gets to the point I made from our survey in that it doesn't appear that climate change is being reflected in asset pricing necessarily, right? In risk pricing at the moment. If you look at real estate values around the world, locations close to the coast are still very valuable, right? And so it doesn't appear that there's a lot of assessment of the impact of climate change over time with the value of that property that may be close to a coast, for example. So I think as I don't know what will be the tipping point, but at some point, assuming climate change, we all believe in it, and rising sea levels will harm property that's close to the coastline. We need to be assessing that risk and thinking about the long-term valuation issues associated with a 30-year mortgage. And I suspect you'll probably start seeing, something within the mortgage product, I guess, that the pricing of it, maybe there's a higher interest rate on a mortgage on a home that's closer to the water, and the insurance products that are being thought about or developed that will address some of these issues as well are also a big part of the solution, right? In terms of risk mitigation. I know we've talked to insurance companies. They are trying to develop specific products for climate change. It's a little difficult because one can argue, how do you differentiate between acute or chronic physical risk due to climate change versus just, well, this was a weather event. I mean, it's a little difficult, but there are products being developed that, and it's very regional specific, right? I mean, storms happen potentially in a specific region, impact different regions differently. So, there are products developed in the insurance market that help mitigate some of that risk, a climate perspective.
Well, something you are naturally you are facing while you are working with regulators is not only when we talk about temperature, it's going to be reflected on water availability, on assets life, as we were talking, biodiversity, subsistence. So many part of our biodiversity will change with the climate change, but mainly quality of life. It goes through people, and it also affects policies, not only about what climate change is, it's also about policies of how nations, how people live there on their countries. So there could be some very popular decisions and some very harmful for politicians. And so what is your recommendation while you go through regulators about policies and new regulations, how to drive it politically at the same time to be covering all needs of financial sector and the productive structure, all the organizations who are in manufacture and producing all the goods and services we need. What are the kind of recommendations you as GARP due to governments and regulators?
Well, I can't say that we necessarily make recommendations to regulators on policy. It's not really our place, and we are an independent organization in that regard. But I mean, what you're talking about, for example, extreme heat, right? It makes it difficult to work outside in some places, and so. I mean, that may impact sovereign risk, sovereign credit risk. Some countries may need to think about how they're addressing some of these issues from a sovereign credit perspective. If your GDP is dependent on, if it's dependent on fossil fuels, for example, that's an easy one, right? And the stranded asset problem with fossil fuels doesn't seem to be a big issue right now, but it could be down the road. And so if you're a country that relies on tax revenue or revenue generally from oil, at some point there may be a problem. So governments need to think about not only like protecting the financial system and the banks from loan deterioration for counterparties that are impacted by climate change, but also their economies in general and their macroeconomies, the ability of people to work. If in India, for example, or in other parts of the world, we've seen extreme heat this year where, I mean, working outside in agriculture, for example, when temperatures are 110 degrees, that's probably not sustainable long term. And so your economy will be impacted by all of that. Yeah, I completely agree with you, and these are some of the issues that need to be addressed. GARP is not in a position, and that's not really our place to recommend what to do to regulators. But we can certainly listen and learn and gain insight on the issues.
It caught my attention on your survey the fact that it's going over. It's going to higher positions of responsibility to look after not only risk management related to climate change, all to the policies and things that companies, all the initiatives that companies will drive in order to be not only responsible, also to be able to give more of what is basically needed to mitigate climate change and also sustainability, what you were explaining, that takes much more different issues. So in the case of the companies, of the firms, how do GARP helps? Because there is also one important point, which is ethics. we have to work on it with a lot of ethics, not only to make the greenwashing, it's also to be a fact of change in the world we are facing, and the world we have to work a lot, whether we want to keep it near or where we are now. How you start driving with C-levels and executives, all this new plan of change or new plan to be responsible in a long term, and also to be addressed with an ethics plan in companies.
So creating corporate ethic programs, that's a tough one. I mean, I think ethical behavior conceptually, fundamentally, is driven by individuals, and I mean, GARP doesn't necessarily suggest or we have a code of conduct that we work by at the organization at GARP, and we expect our certified FRMs and our members to be ethical, but that's hard for us to police. I mean, we can't to some extent, I guess. And it's not, we're not creating ethical programs for companies. At the end of the day, individuals need to be accountable and take responsibility for their actions. And, we've seen in the press, you mentioned greenwashing. I mean, that is something that's been brought up within the asset management community around responsible investing programs and sustainable investing programs. Firms, need to look, and they're looking in the mirror and, making sure that they have the right processes in place to ensure that this type of behavior doesn't happen. And that starts with the people working at the firms, I guess, right? Again, getting back to the point, ethics is, in some respect, largely driven by individuals and who they are as human beings. You either kind of act ethically or you don't naturally act ethically. I guess rule of law has some influence on all of that, but fundamentally it's a human nature type of thing. Does that make sense?
Yes,
it's a tough question. It's a good question, but it's tough for me to answer, frankly.
Yes, no, it's part of what we are facing in the whole world.
Yeah.
Which counterparties or sectors warrant an organization's attention and focus when it comes to climate change?
No, that's a good question, and I would say every organization needs to be thinking about climate change from the perspective of their impact on the environment and the environment's impact on their organization, right? I mean, so that starts with impact on the environment and understanding your scope 1, 2, and 3 emissions as a corporate, and then the impact of the environment on your company. If you're a manufacturer which has a deep supply chain in Asia, for example, you need to understand what potential physical climate exposures you might have in that part of the world in your facilities that may render them, useless or not workable. I mean, we see in China in the last several weeks extreme heat, right? Which they don't have electricity capacity in some provinces in China where heavy manufacturing is taking place to service all of those plants. And so they've had to do shutdowns. I think, some of the technology suppliers in the US and other parts of the world who have rely on parts from China, there's been a bit of a supply disruption, I believe, because of plant shutdowns resulting from the extreme heat in China and some of the provinces, and the inability of China to, meet the capacity needs. This has all been written about. It's in the papers if you want to take a look at it. But I mean, that's a great example of physical climate change having an impact on corporates deep in supply chains in different parts of the world.
For companies who go on depth and extent in those topics, how will you define it? Is a fact of compliance or culture, of cultural organizations' culture? Who
I'm
are
sorry,
the
I
ones
didn't.
who go further?
Oh, the ones that are making great progress on developing
Yes.
risk management programs. I mean,
Yes.
it's cultural. I think it starts at the board. I think it's cultural within the organization. If there's a strong risk culture, there's a stronger impetus to take action and understand, all right, what do we need to do to assess, manage and report on our climate exposures? What do we need to do to ensure our lending portfolios are aligned to a net zero target or a temperature target or whatever the case may be? Are we thinking about how we're going to allocate risk capital if regulators ask us to, increase capital for certain lending to certain industries? Those type of issues. It all starts at the top with the culture, the risk culture within the organization. And we go ahead. I'm sorry.
No, go on, please. Go on.
Oh, I was going to say, I mean, we as I had mentioned, we talked to a number of large banks around the world who are building capacity on climate. They're using the SCR as a resource, the GARP's SCR certificate as a resource, or they're certainly looking to GARP for content around these issues to help build that awareness and build that culture within the company.
Something you talked minutes ago are about all industries in different environments will have a different kind of risks, and the measurement has to be developed in a different way. But there are some very specially sensitive industries. For example, food industry. What will happen in the moment that the raw materials, that the what you need to produce canned products, for example, you have climate problems and you won't have the harvest in order to produce all these products that have to go to the market. How you measure those risks that will affect directly the value chains of the different industries? How do GARP is working with those industries, especially sensitive to climate change?
Yeah,
like food industry.
Yeah, so that's a good question. There is an organization in the U.S., the Environmental Defense Fund, I know has done, and we've had somebody from the Environmental Defense Fund on one of our podcasts talking about climate risk within the agricultural sector, and frankly, and this is U.S. specific, I know, but getting the farming community up to speed on these issues and understanding how physical climate can impact crop yields. Now, to your question about supply chains and assessing risk and assessing, all those types of issues, I guess for a company, it starts with looking around the globe and understanding where your ag inputs or your food inputs are coming from for your production and distribution of products, understanding where those areas sit, where your producers are, and as a physical issue, physical climate risk is very regional. Looking at scenario analysis over time for what the physical risk impact may be on a specific area or specific areas where you rely on agricultural supplies. The Ukraine crisis currently, as we know, Ukraine is a big supplier of wheat, for example, edible oils, I believe. And so there's been that's a great example of agricultural supply chain disruption that's affecting food prices around the world, right? You can just kind of overlay what's going on in Ukraine with climate change and say, okay, in a specific country, let's say Spain, where maybe there's a lot of olive oil, for example, and in Spain you get a low yield on olive oil, and that reduces the supply of edible oils around the world. Just understanding where in the world your supplies are coming from, and then kind of narrowly looking at over a 10, 15, 20, 30-year time horizon, what is the expectation for that region when it comes to climate change and the impact and it's more of a chronic physical issue, right, over time that you need to be thinking about.
What's your forecast about green finances? How do the offer of the financial markets will evolve for the next years related to green projects, to all green investment? What's your forecast?
Well, I mean, whatever forecast they come up with will probably be incorrect. But I would say in general, the green finance market, the sustainable finance market has grown tremendously over the last several years, and I do think the Paris Agreement has been a big impetus for that. As I stated in the presentation, there were several factors coming out of the Paris Agreement that have helped support some of these initiatives. I think the green finance market will continue to grow. I think there is certainly investor interest in these types of products, it seems. Now, getting back to your moral question, I mean, maybe there becomes some skepticism about the products themselves. I don't know, over time. But from what I'm observing, there's an upward trend. We're looking at an upward trend, continued upward trend in green bond issuance or sustainability-linked loans, or you name the product. I think it will continue to grow.
Well, and a last point will be, how do you think it will evolve, the way that assessment to organizations, the ESG assessment, what is going to be taking in the next years as priorities of organizations, of firms, in order to give a higher qualification to all to any kind of financial opportunity, or also to be validated in front of the markets?
Well, I mean, I would say, generally speaking, that corporates are very aware of the investor interest in something like ESG or sustainability at a corporate level, and investors seem to have a stronger preference for companies that take these issues seriously. And if you look at corporate hiring trends, I mean, the chief sustainability officer within companies. Now, this isn't necessarily climate risk specific. This is more broadly the company's like ESG point person or sustainability point person within the firm that reports to often the CEO or may report to the CFO. Those people are engaged with the risk groups on climate. They're engaged with diversity inclusion issues. They're engaged with, if it's a beverage company, they're thinking about water resources and aligning with organizations that can help support, collaborate on, how do we address this issue and water shortages around the world, which is a critical issue, right? And that's an extension of climate change. So corporates are well aware of the need to have these types of positions in their firms and look at these issues. And they also understand that there's increased value in their organizations potentially because of investor interest in seeing this type of support from the organizations.
Well, thank you very much, Michael. It was been a great lecture, and also lots of it's to meet GARP as a huge offer we have for organizations in order not only to validate what we are doing, also to redesign our plans in the long term. Thank you very much. It has been a great morning.
Yeah, thank you very much. I've enjoyed the conversation, and we look forward to working with you guys going forward. You guys are doing a lot of great work there as well. So thank you.
Thank you very much, Michael Sell. Y de esta manera vamos a continuar ahora con el último keynote de la Risk Management, de esta Risk Management and Trading Conference 2022. Tenemos uno de los paneles que sin duda alguna nos va a dejar no solamente, es conferencia magistral, no es panel, y estamos hablando de un mexicano que en el mundo entero está dando mucho de qué hablar y hablar muy bien. Un mexicano cuya familia ha estado metida en el sector financiero, así como también en las iniciativas no solamente de responsabilidad social, de sostenibilidad. Ha sido una familia muy activa, muy comprometida.